The signs of strain were evident again today in the U.S. housing market. The latest numbers highlighted how tough it has been to fix a vital economic sector. Tonight, we look at the housing news as we begin a series, After the Fall, on how Wall Street, the economy, and financial regulation have changed since the crisis of 2008. Builders have been cutting back on housing construction. But in March, there were still more new homes for sale than people wanted to buy. The National Association of Realtors reports sales last month fell over 7%, the most in more than a year. Overall, some 328,000 homes sold, less than half the rate in a healthy market. And a closely watched index found home prices fell 1% as well. They've been falling for 6 months in a row. Overall, the data underscore just how much the housing market continues to struggle, 4 years after the mortgage meltdown. The Bush and Obama administrations both created programs to stem foreclosures, but they have come up short. One program designed to help 4 million homeowners refinance has led to just about 900,000 permanent loan modifications so far. President Obama acknowledged the shortcomings in February.
I'll be honest, the programs that we put forward haven't worked at the scale that we hoped. Too many families haven't been able to take advantage of the low rates because falling prices locked them out of the market. They were underwater, made it more difficult for them to refinance.
The Republican presidential nominee, apparent Mitt Romney, has dismissed the idea of a separate plan to fix housing.
There's an effort on the part of people in Washington to think somehow they know better than markets how to rebalance America's economy. The right course is to let markets work. And in order to get markets to work and to help people, the best thing we can do is to get the economy going.
Meanwhile, a new wave of foreclosures is building. In February, about half of the 50 states reported sharp increases in foreclosure activity. With more than 4 million homes foreclosed on since 2007 and the housing market struggling, we assess efforts by the government and lenders to deal with the problem. Andrew Jacobovics is head of research at Enterprise Community Partners, an affordable housing nonprofit. He was until recently an advisor at the Department of Housing and Urban Development. And Mark Calabria is director of financial regulation studies at the Cato Institute and a former Republican staff member for the Senate Committee on Banking, Housing, and Urban Affairs. And gentlemen, it's good to have you both with us.
Thank you.
Thank you. Mark Calabria, let me start with you. Did the programs that were instituted by the government under both President Bush and President Obama, did they address the problem? How much? How little?
I think both, and I'd say this is nonpartisan because I do think that the Obama administration largely continued the same theme of the Bush administration, which to my extent was to put off the problem, to kick the can down the road in a lot of ways. I look at the fundamental issue of our housing market as a combination of weak demand and excess supply. And so some of these things were, of course, aimed at keeping foreclosures off the market, which would lower supply, but ultimately they drove out the problem. I'm of the opinion that if we had taken the 30% decline in 6 months rather than 4 years, we'd be in a much healthier spot today. So I think ultimately market fundamentals asserted themselves, whether you wanted them to or not. It was really a matter of the speed of adjustment.
And you're saying the measures that were taken by the government made the problem worse?
In many cases, I do think that they did. For instance, I do think you encourage people to stay in place. I like to use my stylized example of if you're a carpenter in Tampa, you're not going to find a job in Tampa as a carpenter anytime soon. That market is way overbuilt. But if you have a situation where you can be in that house for potentially 2 years or more without paying rent and you're getting unemployment insurance, you really have very little incentive to maybe move to Austin or Atlanta or Dallas or somewhere there's creating jobs. So I think to some extent these programs have put our labor market in limbo, and I think that that's been a detrimental. I also think to some extent you've kicked the can down the road. Almost half of foreclosures today are people who were previously in foreclosure at some point in the past. So again, I think you need to separate out the home buyers we can help from those who we can't help and try to speed that process along.
Andrew Jacobovics, how do you see government measures that have been taken?
So I actually think that Mark's analysis of sort of what the problem is in terms of oversupply and weak demand is right. But I think that the efforts that have been made to date certainly fallen short of what I think have been needed to really restore the market to its normal health. But by and large, we're better off today with those programs available than had we let the market fall. I think the risk of overcorrection and the spillover effects. I mean, a foreclosure doesn't just impact an individual; it impacts their neighbors, it impacts their communities, and understanding what that does to the prices more globally of a single foreclosure and then obviously concentrated foreclosures, those impacts are significant.
So what are just a couple of examples of where you think it's worked?
I think the fact we haven't really talked as a policy much. We talk a lot about the modification programs. We talk about the refinancing opportunities.
Making it easier for people to
make their mortgage payments. Right. Reducing HAMP, which is the Home Affordable Modification Program. Borrowers who apply for assistance, they have to demonstrate hardship, but they also have to demonstrate an ability to make payments at least at 31% of their income. So it's not sort of a freebie by any stretch of the imagination, and unfortunately, the way it's been executed, I think, leaves a lot to be desired in terms of it's very hard for a lot of folks to actually get the assistance that they might qualify for.
But on balance, you think it's better having had these programs
Without
than
doubt.
not?
Judy, if I could make 2 points
Sure.
really quick. I mean, one, there's a simple empirical question of did we stop more foreclosures than we would have had otherwise? And this is not a difference between whether we had this foreclosure 2 years ago or today. And I'd say we simply don't know the answer to that. My suspicion is the vast majority of these foreclosures that were going to happen otherwise. But what really concerns me, to go back to my supply question, is what builders look at, and in the typical markup on a home is 30-40%. And so, I remember these stories where Pulte is like, I'm going to build underneath the foreclosure point. And so my point is, if you put efforts to keep prices up, you encourage more construction by builders, which actually, in the long run, adds to the glut. So you end up with more supply than you would have otherwise if prices had fallen faster. You really want prices to get below construction costs so you can encourage builders. And I say that in recognition that constructions have been at historic lows, but they've still been quite positive.
What more do you think? You want to respond to that?
Well, I just think that, I think we are at historic lows, and it's a question of where that construction is taking place. Not all markets have been hit equally, and certainly the places that have fallen the furthest, there is basically no new construction because the excess supply, both of unsold, newly constructed homes, as well as just the available properties that have been through foreclosure, or individuals who want to just simply put their home up for sale to take advantage of low interest rates or move someplace else, I think are really important as well.
What have you seen in Andrew Jakubovic in the behavior of banks and of lenders? What's changed in the last few years?
Well, I certainly think that when the crisis hit, the way they approached borrowers who were delinquent was one of just debt collection. Our borrowers are deadbeats. I think the language has significantly changed. It used to be about loss mitigation. How do we kind of squeeze every last drop out of a borrower? And I think the mindset is now about loan modification. How do we work with a borrower to be able to keep them in their home? And I think that the consistent theme, at least the way the administration has rolled out its programs, has always been with a sensitivity to what the value of the property is at the end of the day, the value to the investor. So it's less, I'd love to have seen greater assistance to homeowners, but it's within recognition of the fact that at the end of the day, there are existing contracts and we need to respect the investors who own these loans.
For example, writing down the principal. That was something that wasn't talked about until much more recently.
Right. I would have liked to actually have seen that far earlier on in the policy conversation. I think it's a very powerful tool that can right-size the mortgage market, sort of squeeze out the excess pricing. And really, to the extent that it encourages people to stay in their homes and make their payments, I think it can be a powerful tool.
And I want to emphasize something that I fully agree with here with Andrew, that our system prior to the crisis was really set up to be a foreclosure system. It was not a loss mitigation system. It was originate a loan, sell it into a mortgage-backed security, the trustee demands you foreclose it. So it really was not set up in that way. If you go back to, say, pre the S&L crisis, when we had a deposit-based system, you went to your local lender and you got a loan, you went to him when you got in trouble, you talked to them, they weighed your situation, and sometimes you got a modification. So I think one of the things we need to keep in mind going forward when we look at what our mortgage finance system should be is that the advantages of a deposit system give you more flexibility to do modifications than the securitization system we've embraced. So I do think we need to question whether we want to have a mortgage system so reliant on securitization in the future.
Well, let me ask you both just to conclude by looking ahead. Where do you see the housing market headed right now? Mark Calabria, do you see people who want to buy a home having the option of buying a home? People who
you could caveat that if you have good credit and you can put a down payment. Otherwise, FHA is really the only option for low down payment, and even they have increased their standards. So certainly at this point in time, I think that there's a lack of creditability for marginal borrowers, and certainly some of the credit that went away.
Do you see that changing?
Not a lot. Honestly, I think credit availability is going to be a problem. I think it's going to moderate a little bit. I also think we're getting close to hitting bottom in prices. We have another, like maybe 2 or 3 percentage points over the year, but I actually think we're getting near bottom, and I would have not have said that 6 months ago.
Andrew Jakubovics, how do you see the future near term?
Near term, I agree with Mark. I think we're probably sort of bouncing along the bottom, but I certainly think that the issue of credit availability, particularly for places that have been hard hit by foreclosures, there's not a whole lot of ability for someone who wants to buy in these places to come in simply because of the tight credit. Folks who can get the credit will certainly choose, the places where the prices have fallen significantly and can now get into some really fancy houses at much lower cost than they could have a couple of years ago. So the places that have been really hard hit are the ones that are continuing to struggle.
Well, I have a feeling that people are going to be hanging on every good syllable, positive syllable.
They should keep in mind that despite some of the comments from the Federal Reserve, I mean, mortgage rates are as low as they're going to get, and they're not going to stay this low forever. Exactly.
Mark Calabria, Andrew Jakubovics, we thank you both.
Thank you.
Our series, After the Fall, accompanies a 4-hour frontline investigation into the financial crisis called Money, Power, and Wall Street. The report examines, among other factors, how bad decisions about mortgage-backed investments helped trigger the crisis. A case in point, the sudden collapse of the investment bank Bear Stearns just 3 years ago, and the government's decision to try to help save it. Here's an excerpt.
With the exception of Bear Stearns.
The rumors swirling around Bear were about its massive investments in subprime mortgages, what would become known as toxic assets.
They were big in mortgages. They were big in packaging them and creating securities out of them, buying them.
The road to riches for Bear was simple. Buy hundreds of thousands of subprime mortgages, then bundle and sell them to investors. But now the party was over, and Bear was spiraling out of control.
It was nothing short of surreal.
Those are the kinds of concerns in this market, concerns of confidence.
You're watching on CNBC, etc. I mean, they're talking about where you work.
Well, the only bank in the red right now, basically, Bear Stearns, although it is dragging the rest of the financial markets down as well.
The stock was in free fall, and the cash reserves were shrinking.
The stock started to go down. More and more people called up and said, I want my money out, or I won't trade with Bear Stearns, and it just completely unwound.
Nearly bankrupt, the top brass at Bear called Wall Street super lawyer Rajan Cohen.
It became clear that they were having serious funding difficulties, and it had been very clear to me that a investment bank has a very short lifespan after it loses its liquidity.
Cohen made an emergency call to Timothy Geithner, the president of the New York Federal Reserve.
Geithner understood that it was a vulnerable situation. He said something like, "Believe me, I'll be on it," and that was really the phone call.
Geithner was Bear's last chance.
Tim Geithner is at the Federal Reserve Bank of New York. It's the epicenter of the financial system. He is supposed to be the Fed's frontline general, field marshal in the financial markets.
He's 47 years old. He looks like he's about 32.
Extremely smart, extremely aware of the stuff, very discreet, controlled.
Geithner realized he needed to know how bad Bear's books looked. He dispatched a SWAT team of investigators from the Federal Reserve to Bear's headquarters.
Tim Geithner is frantically involved in trying to figure out what's going to happen if Bear melts down and how you need to prevent it from going into free fall and dragging down the rest of the financial sector with it.
By midnight, by 1, 2 in the morning, everybody and their mother has teams at Bear. Morgan, the Fed, the SEC, and they find out Bear is stuffed to the gills with toxic waste.
Bear was party to complicated financial deals.
Nobody understood how subprime mortgages had proliferated through these things called credit default swaps, and nobody understood how they'd kind of gotten into the blood of the financial system.
Geithner learned that Bear had made credit default swap deals worth trillions of dollars all over Wall Street and around the world.
Because Bear Stearns was so indebted to so many other people, their failure to repay their debts or pay their debts would cause a cascade of other failures.
Geithner saw what central bankers fear most: systemic risk. Bear was frighteningly interconnected with other banks up and down Wall Street.
No one knew what would be the ramifications, which other institutions were exposed, which other institutions would suffer runs.
Bear Stearns, Geithner concluded, was too big to fail. A bankruptcy could undermine confidence in every major Wall Street firm.
Frontline airs tonight on most PBS stations.